Hello, I'm David Rubenstein. I'm here today with Bill Ackman, the noted investor and philanthropist and increasingly tennis player. So, Bill, thank you very much for joining us today.
Nice to see you.
Okay, Bill, the markets seem to be strange to somebody who's not following them quite the way that you do. The economy seems to be in a recession, a fairly deep recession, yet the market is almost where it was when we started this recession. Can you explain that, why the market seems to be so much higher than the economy is?
Sure. So, when people talk about the market, they talk about either the Dow or the S&P 500. And the S&P 500 is a market cap weighted index. And what's interesting or fortunate and unfortunate about the crisis is it affects different companies differently. And the more dominant large cap, companies, the stronger the balance sheet, the stronger the market position. Those businesses are huge beneficiaries of the crisis. And what the market does not reflect are small businesses, private companies, more levered businesses that don't have access to capital, don't have the same dominance as the public market. So a business like Amazon, which is a very big component of the market, is up 45%. That does a lot, obviously, for the averages. It's probably something approaching almost 10% of the S&P index today. My guess is 6-7 percentage points of the index. Businesses like Google, Facebook, I think long-term beneficiaries. And ultimately, the value of a business is the present value of the cash it generates over its life. And even if the cash flows are disrupted in the short term, if they're greater in the long term, the values will be higher. So I think the stock market is a snapshot of a portion of the economy. If you had an index of smaller businesses, the market would be down 50, 60, 70, 80%.
So the market also seems to gyrate more than normally. We have market going up 1,000 points, down 1,000 points. Is that because of computerized trading, or why is the market gyrating so much?
Again, the market is a discounting mechanism, and people's estimates of the future have been very volatile. How long is the crisis going to go on for? When will we get back to our normal life? These things affect the input of the model that analysts are using to value securities. I think the other issue is the market in the short term is very much a sentiment index. It's a way for people to express their emotions. And there's been a lot of emotions in the short term. And when that happens, there's a corresponding degree of volatility. But I don't think the market is dramatically wrong. When you look at the market on a company by company basis, when we look at the companies we own, different businesses have been affected differently. Many businesses will be long-term beneficiaries.
Not long ago, you made a very spectacular investment. As I remember it, it was $27 million you put on a hedge, in effect, and it became worth more or less $2.6 billion, something like that, about 100 times your money. So I don't know if you've done a lot of those 100 times your money deals, but was that something that you expected that would go up that much? And you were later criticized by some for having gone on CNBC and kind of talked down the market at the time when you had a short position. Can you explain why you made the investment and why the criticism might not have been fair?
Sure. So what we did is we bet that credit spreads would widen, which I thought was a very, very low risk bet in the sense that credit spreads were at the all-time tightest levels ever, going into what I thought would be a fairly serious economic crisis. If we were wrong about the economic impact of the crisis, we would have paid, again, a relatively modest amount of premium, to be wrong. So it was a very asymmetric bet, and unfortunately, things played out the way we expected in terms of the economic impact of the crisis. If you actually watch my CNBC segment, all 28 minutes of it, which I think a lot of people didn't do, as opposed to the snippets that CNBC advertised after my presentation, I actually gave where I said, well, look, we're at a fork in the road. If we go down one fork, it's doom and damnation. And that fork was a one in which we did not, in effect, shut down the country briefly and carefully reopen the country. If we went down, just let the virus go roughshod, I felt it would have very dramatic economic and health implications. That was the part I was most concerned about. But as I said in my 28-minute presentation, that I was actually quite bullish because I was very confident that the government would, in effect, shut down the country, and that would stunt the growth of the virus, allow us to reopen the economy. And what I said on CNBC, that's why I'm buying stocks. And we went bullish. We were very, very bearish going into March 12th. And on the 12th, we started buying stocks very aggressively, and we started unwinding our hedge as quickly as possible. I went on CNBC on the 18th. By the 18th, I had 3.3 billion more exposure than I did on the 12th. And I was really, in a way, I was talking my book, and my book was bullish. I was betting that the country would be shut down. And fortunately, I think for the country, California initiated the shutdown within 24 hours, and then New York State, and then the rest of the states have largely followed. And that's why you're going to have the opportunity for an economic recovery, and the virus will kill, only 150,000 people instead of, what could have been millions. But the unfortunate part is the CNBC ran 30-second segments where I talked about the fork in the road of doom and damnation, and they didn't run the segments where I was saying, actually, I'm bullish. So if you go back and watch, you'll come away with a very different impression than some people
Okay.
perceive based on short snippets.
Well, do you have any more 100 times your money bets that you might be able to give to us, where somebody might be able to make 100 times their money in the not too distant future? Any good bets you might recommend?
Sure. So it's a bit of an overstatement to say, we ended up, spending $27 million on the insurance policy on which we collected 2.6 billion. But we had to, the way that bet is entered into is you commit to pay $500 million per year for 5 years. And the longer you keep it on, the more you can lose. So it's a little bit different than someone who can scrape together, $10,000 and make 100 times. So it's a bit of an overstatement to say we made 100 times, but it was a very good hedge, and we were able to invest the money in the market and protect our investors' capital, so we felt good about it.
Okay, so let's say, Bill, I told you today with absolute certainty, no doubt about it, that the next president of the United States would be Donald Trump. He's going to be reelected. You knew for certain. Would you short the market? Would you go long the market? What would you do?
It really wouldn't change anything that we're doing. Our strategy is to buy super high quality, dominant companies that can withstand a pandemic or a dramatic movement in interest rates that are not particularly exposed to the economy. So, who the president is, it's not something that we would make a bet one way or another on the portfolio.
Okay. The same thing would be true of Biden. If I told you with certainty he's going to be the next president, you wouldn't change your views, right?
No.
Okay. So you are what's called an activist investor, not a macro investor. An activist investor typically invests in companies or makes specific bets on companies, the direction up or down and so forth. How did you get into being an activist investor as opposed to, let's say, a value investor, a macro investor? Was it something you decided to do while you were in college or early in your professional career? What led you into that route?
I think it's part of my personality. I started as an investor. I raised the first pool of capital when I was 26. And I made an early investment in a company called Rockefeller Center Properties. And I saw management making a series of decisions that made no sense to me. And it was just so obvious the right thing to do as to how to create value. And it was being a frustrated passive investor that made me into an active investor. And that investment turned into a very profitable and very high profile investment. And with success, one is motivated to try it again. And it's been helpful to the strategy over a very long period of time. And it's fun. And if you're passive, you can feel like the market's patsy. And if you're active, you can actually create some value. And I think it's a lot more interesting than just picking securities. We bought a stake in Chipotle at a time where the company was struggling a few years ago. We put a few directors on the board. We recruited a new CEO named Brian Nickel. It's completely turned around the company. The stock is, almost tripled in the midst of a crisis. And it just tells you that, that's a lot more fun and it's a lot more profitable. And it's, I would say, a lot more good for America than just simply being a passive stock picker.
So Pershing Square was started in 2004, your current vehicle. Where did you get the name Pershing Square?
Sure. So right in front of Grand Central Station used to be a square that was an open grass, sort of public gathering space. Over time, Grand Central Station was built. There's that little bridge over it, but it's that location is still called Pershing Square, and our offices were at the corner of right in front there, 110 East 42nd Street. So I liked the name, and it was available. So that's what led to our choosing it.
You started in 2004, Pershing Square, with I think $54 million. So if
Yes.
somebody had invested in 2004, part of that 54 million, and they kept it with you, what kind of compounded rate of return would they have today?
You would have about 11 times your money and about a 16% IRR.
Okay, and are there people that have done that kept their money there the whole time?
Yes, the very loyal ones. It's not been a straight
Okay.
line up, to be clear.
Okay, so let's talk about for a moment some of the campaigns you've done as activists. Some of them have worked out, some have not. Chipotle has seems to have worked out, but you did a couple that were difficult ones. So Herbalife or Valiant, they didn't work out. What would you say is the mistake you made in hindsight, and that you would try to avoid in the future?
Sure. So there's sort of 8 principles that have driven our investment success. And when we have veered from those 8 principles, we've lost money. And after the 2000, we went through a very difficult period, circa 2015, 2016. The 2 investments you mentioned were big drivers of that. It was a, if you will, experiences making mistakes and learning from them. And it was a moment of reflection for the firm. And I went back to the core principles that have driven our success for the first 12 years. And I had a member of the investment team literally engrave them in a stone tablet, not dissimilar from Moses's 10 Commandments. And I had that stone tablet put in a, what you might call a deal toy, sits on everyone's desk in the office. And we've adhered to those principles, ever since. And, we've been fortunate to return to the success we had for the first dozen years. So I think it's about keeping to, our principles are basically, we want to invest in simple, predictable, free cash flow generative, dominant companies with large barriers to entry that earn high returns on capital, that have limited exposure to extrinsic risk we can't control, strong balance sheets, don't need access to capital to survive, have excellent management, good governance. Sounds logical, but occasionally we've diverged, and there's those times. There's a certain discipline that comes with investments, and there always seems to be a countervailing quality that caused us to diverge. But in really each case where we've compromised on business quality or complexity, we've been harmed from an investment standpoint.
To be an activist investor, my impression is you have to be a fairly tough person. You can't be a shy, retiring person because people are going to criticize you. So, did you develop a thick skin relatively early? And do you feel okay being confrontational at times, or is that a problem because you're just not your personality?
Sure, I'm generally not a confrontational person. I had my one little episode with Carlyle on CNBC that had got a fair amount of attention. I didn't actually choose to debate Carlyle on television. To the credit of the network, they they brought him on in the middle of an interview like this one, where we both had an opposing point of view. On an investment, I do think it's a strategy that requires a thick skin. But I think anyone who takes high profile positions, not just on investments, but on any issue, particularly at this moment in history, is going to get slammed by one side of the debate. It's the inherent nature of a divisive country, and fairly strong opinions on both sides. But I've always had the view that if you take a public strong position that you have a lot of conviction in, you're guaranteed, and no one pays attention, that maybe there isn't that much substance to what you have to say. So I guess I take it as favorable, and can also often be instructive to hear the opposing point of view, as long as it's not an ad hominem criticism. I have no objection to someone taking the opposing point of view at all.
Let's talk about the economy for a moment. Right now, it seems as if we've borrowed an enormous amount of money to pay for the recession, in effect. The Fed has put up maybe $4 to $6 trillion off its balance sheet. Congress has maybe put up so far 3+ trillion, maybe close to 4 trillion. So are you worried about the debt having an impact on the economy in terms of the value of the dollar, inflation, or just the size of the debt and our ability to pay it off?
Sure. So, if you think about the country as a business, the country has a lot of intrinsic value, a lot of asset value. I would say one of the most valuable assets of the country is the country owns 35% of your income and my income. In a way, you can think about that. That's the current level of taxation, federal taxation. So that's, in effect, the country owns a 35% stake in your intrinsic value and my intrinsic value as a contributor to the economy, and the country retains the right to change that percentage ownership at its will by in fact changing obviously tax policy. So there is, then of course we have enormous assets, whether they're real estate assets or infrastructure assets, that are. So I think the asset side of the U.S. balance sheet is very, very large. Obviously, you'd never want to let the liability side of the balance sheet grow too much, and there are a lot of not just debt liabilities we have outstanding, but we have Social Security, the enormous healthcare costs, Medicare, Medicaid, et cetera, that we bear as a country. So it's something that is concerning. We are fortunate finding ourselves in a very low interest rate environment, but it's something to think about and be concerned about. But it's sort of difficult to do the same kind of calculation of the leverage nature of the United States unless you do a proper valuation of the asset side of the balance sheet.
So we're in a technical recession. We're technically in a recession, I should say, and fairly deep. But right now, when do you think we're likely to come out of this recession? In the third quarter, fourth quarter, next year? Do you have any views?
Yeah, I think we're going to, begin a recovery, certainly by year end. I don't think we'll be back to anything close to a normal economy until probably the second half of 2021. I think if we have an early vaccine, Pfizer's been talking about a potential distributable vaccine by the fall, that will obviously make an enormous difference. I think if we can reduce the treatment of the virus to, one a test you can take at home and get an accurate result in 15 minutes, and it's telemedicine to your doctor to get, for the doctor to say, okay, you need a prescription for remdesivir in a inhaler format, and you can stay home for 2 weeks and be fine. Those things will make a fairly significant, positive impact. But I think we've had kind of a sloppy closure of the country for the virus, and we're having a bit of a sloppy opening. So I think you're not going to have business confidence return and consumer confidence return until the kind of people feel safe, truly safe. If I had to guess, that's really more like the second half of next year and into the beginnings in Q4 and Q1 and Q2 of next year.
You've said sloppy opening. What you mean is there's a lot of cases in Texas and Florida of people getting virus now, and it doesn't seem like it's disappeared. So are you worried that this could, without a vaccine, keep going on through all of 21?
I think what will happen is, the healthcare system is getting better and better at treating the virus. So, they're learning when to put people on a ventilator, more importantly, when not to. They're learning which drugs can have a positive effect and learning more about what doses and earlier, when to give the medication. Testing is improving. And I think all of these things are positives and will improve confidence and reduce, kind of risk. Things will be a lot better, I think, in a few months, although you're going to have some states with a lot more cases because people have not been careful, and those states are going to have to moderate economic activity and maybe, go to a mode of protecting more aggressively, people at risk and being more cautious, again, all the things which will temper the economic recovery. But I do see a, kind of gradual improvement in all fronts as the global healthcare system, every medical researcher in the world basically working on solving one problem and a lot of resources going into it. So I think by the fall we'll feel a lot better if we can take death off the table, if we can take severe illness off the table. I think that's certainly possible in this calendar year. People are going to feel a lot better about living and going out and living a more normal life.
So if Jay Powell called you tomorrow and said, look, I'm not sure what I should do. Should I do more? And if the Secretary of Treasury, Steve Mnuchin, called you tomorrow, should I pass another bill working with Congress? What would you tell both of them? Would you say we need more help from the Fed, we need more help from Congress, or would you say we've had enough help?
Look, I think we have to protect the most vulnerable people economically during this period of time, and I don't know when do these programs precisely run out. You need to design programs. I've heard, and we've made a lot of investments in the restaurant industry, where some of the benefits are at a level where they're better than $15 per hour, sort of the minimum entry points for many private businesses, and it discourages people returning to work. So you need to design them in such a way that you don't reduce economic incentives to return to work, but you have to have them large enough to protect people during one of the more challenging times, particularly for people at the lower end of the economic scale.
Now, you mentioned earlier that tech companies seem to have done pretty well. Your firm seems to invest more in, let's say, consumer retail, or at least some of the visible ones are in that area. Are you a tech investor in the sense of investing in tech companies, or is that something you plan to do in the future, or you wish you had done more of?
Sure. So look, there are always investments I would rather not have missed. I feel like I could have figured out Amazon, but that's a backward-looking sort of approach. But I don't think Amazon so much as a technology company. In the same way, Starbucks is in a way a technology company. One of its competitive advantages versus the corner coffee shop is its digital ordering and delivery and contactless way of interacting with customers. I think every business is a technology company. What we are not is we're not investors in pure technology companies. We wouldn't invest in a self-driving company with no revenues, but we might invest in a, many of the businesses we own are heavy users of technology, whether they're consumer facing or whether they're industrial companies or manufacturing businesses. We're looking for businesses with very attractive economic characteristics. There are many so-called companies that are in the NASDAQ. People think of them as tech companies, but they have the kind of economic characteristics we like. We just don't like businesses where a couple of young people in a garage, somewhere in Silicon Valley can come up with a disrupting technology that disintermediates the business.
Suppose a young person at your alma mater, Harvard, or any other college said, look, I'm watching Bill Ackman. He's a smart guy. He's making some money. I'd like to do that. I want to be hired by Bill Ackman. What do you look for when you're trying to hire young people? You want somebody that's exactly like you? What are the skills that you're looking for?
So we're really a private equity firm that invests only in the public markets. And so when we've recruited for the investment team, if that's what you're referring to, we're looking for people, the typical candidate spent a couple of years in investment banking, in a great training program at a big firm, a Goldman Sachs, et cetera. Blackstone, or the old version of Blackstone, their Blackstone advisory business, we've recruited some people from there. And then, several years in private equity, because private equity investors focus on simple, predictable, free cash flow generative businesses and focus on businesses that can support a large amount of debt and really determine valuation, think about industry dynamics. So we're looking for someone with, that kind of a background, usually 4 or 5 years out of school. And then they join the team, and we've had a lot of continuity and duration for people who've come to the firm. But we hire very, very few people. We only have a 7-person investment team. The plan is to keep it quite small.
Well, when you had your problems a couple of years ago, you alluded to, and I talked about Valiant, and for example, did you ever lose faith that you would be able to turn your business around? And did you ever doubt that you could make this a successful business again?
Sure. So, I think I've always liked to say that success is not a straight line up. And I would give these talks at business schools about how to deal with failure. And then I failed. And I had to implement the strategy that I was a proponent of to business school students. But I think the key, look, we have a business with a strategy that makes sense. We made some mistakes. Experience is learning from those mistakes. That's the key. And then, I was quite confident that if we adhered to the principles that built the success of the firm, or re-adhered, if you will, that we return to success. And it's a question of duration and every day coming into the office and making decisions with good judgment and being level-headed. And with time, I was confident that things would recover and feel very fortunate that things have worked out the way that we expected. But I'm certainly going to be, now at 54. I'm done making mistakes. So that's my business plan going forward. We're going to be very, very watchful about veering from the course that has led to our success.
In recent months, you've been running your company, I assume, from your home, I assume. And has that made it more difficult or easier? And what have you learned from this experience? You think you can run the company from your home in the future, just like you're doing it now?
We could, but it's far less fun. And that, one of the reasons why we can run the company from our respective homes is that we built a real culture and almost a family-like environment among the people, and a culture of trust and respect. And, we all like each other. But we can succeed doing this because we view it as a temporary solution. I would say, we've been incredibly effective and incredibly productive, working from home. But it's harder to have the separation between your job and your life. I think it's actually very, very helpful to come into an office, and then when you leave it behind you. It's a lot harder. I'm working from if you will, the den where my office is located. My parents' bedroom is, sort of over there. The baby, sometimes I hear her crying in the kitchen, so it's quite beautiful in a way, this moment with, living with my parents for the last almost 4 months, and I have a 13-month-old child. I've got remarried relatively recently. I'm very fortunate to have beautiful family. But it works from a temporary standpoint. And I also think it will be easier if I have a day where I need to focus on family, where I can operate from home, and that's true for other employees. So I think we can get to a model that's better than what we had, but it's going to be centered around an office environment.
Now, in recent years, you've become a very active philanthropist. You've signed the Giving Pledge. You're involved in the Giving Pledge effort. What are the areas that are your greatest passion in philanthropy?
So, I like the inherent leverage of an asymmetric risk reward in business, and I like the same thing in philanthropy. So we've done a lot of investments in what I would describe as early stage businesses that are designed to address social problems. Many of them are nonprofits. Many of them are actually, a B corporation or a for-profit or something in between. And we've had some Google-like outcomes where we've, bet with an organization very, very early. An organization, the organization with a budget of 100,000 or 300,000, and we give them 3 million at a very early stage of their development, and that now they've become, organizations that really move the needle. So I find that stuff very sort of I'm passionate about that kind of structure. But in terms of what we focused on, economic empowerment, social justice, addressing income inequality. We've done some cancer research, kind of backing kind of early, sort of younger scientists before they can get grants from the NIH. It's really been about backing very talented, I would say, entrepreneurs and people who are passionate about solving a problem with either a for-profit solution or a not-for-profit solution. And I'm even more passionate about the for-profit solutions to a problem. Not that we're trying to make a profit, but that we're building a sustainable organization that can address a problem that doesn't need to constantly rely on an annual grant from a foundation.
I mentioned at the beginning that you're a tennis player. You didn't play in college, but you've taken up tennis recently. I think you're pretty well regarded as a tennis player. Do you wish you had played tennis earlier? And if so, do you think you could have been a professional tennis player?
So I played in high school. I was a good state level player. I was told by the Harvard coach that I had a good chance of making the JV, and he told that to about 50 other young people. And there were probably 4 spots on the JV, and the rowing meeting was across the hall. And about 15 minutes into the tennis meeting, when I saw how many people were there, I went across the hall to the rowing meeting. I ended up rowing for 4 years, and it had a profound impact on my life and my ability. Actually, you asked me the question, how do you get through a difficult business period? The answer is it helps to be a rower and endure a severe amount of physical, mental torture, which was a big part of rowing. So I have no regrets. Although the last 15 years I've taken up tennis, and I'm a vastly superior tennis player. I can play a very high level tennis game, much better than I was, when I went to college. So I think I had the best of both worlds. Feel very fortunate.
So I've told you've played with John McEnroe. Can you beat John McEnroe? He's a little bit older than you, or not quite yet
Well,
there?
I played with John McEnroe about 12 years ago. I had kind of a funny incident where we were playing doubles, and it was for a charity, and I hit an overhead, and I hit him with the overhead. I can't think on probably twice in my life I've hit someone with an overhead. He spent the entire rest of the match doing his best to hit me back, which really gives you and by the way, I have a lot of respect for John McEnroe and his personality, but it was a fun moment. I think it's extremely improbable that I could beat John McEnroe in a singles game, but with an equal partner I would give him a good run in the doubles. But yeah, one of the greatest players ever, and I'd really enjoy playing with him, and we'd win a few games and hopefully more.
All right. Well, I hope you get to play again with him. And I want to thank you for taking time to be with us today. And I hope you can find a couple more or less 100 times your money bets, though I realize it wasn't quite 100 times your money, but it was pretty successful. Thanks a lot, Bill.
Thank you so much, David. Appreciate it.